Hello and welcome to the Bullish Bears YouTube channel. I'm Jeremy and this series is going to be called The Wheel Trade. Essentially, I'm going to go over some quick technical analysis on the charts of a couple of specific equities that I like to wheel trade. And I'll give you a little bit of the how and why, as well as a little bit of, I'll just announce current positions. If you do like what we do here, please feel free to like and subscribe to our channel. And if the information in this series happens to really tickle your fancy and you really appreciate it, feel free to shoot us a super like if you would. Any support for this channel helps us keep our operating costs down for our community, and we really appreciate the support. Thank you very much. Moving on. So my first position, and this is kind of my primary wheel trade position, it generates tremendous premium for what it's worth, and cost, outlay per percentage return is an average of about 8% monthly per contract. Natural yield, if I was to just open them and leave the sold to open options running, it would be about 8% per side. So calls and puts combined be about 16% natural yield on this one per dollar outlaid. So what I like to do is I like to sell out of the money cash cover or cash secured puts as well as covered calls. This position I'm long equity, and the idea is to maintain enough capital in your account to acquire twice the position size while maintaining a long position that covers your cash secured puts with cash in your account, as well as a long equity position providing a position to leverage covered calls against. In this one in particular, I like to focus on price action and use that to identify opportunities to sell out of the money strikes for $1 or more. And typically I focus on the 1 to 2 weeks out expiration on this particular equity. My current position on this bad boy is, let me get into that. I have on January 31st, I sold to open a February 14th expiration 48.50 covered call at $1.05 premium per contract. And on the same day, I sold to open a February 14th 42 strike cash secured put at $1.10 per contract. So I have $2.15 worth of premium open on this, and currently I could buy to close those relatively cheaply, as price is fairly neutral and kind of in the middle of my strike range here. So I'm looking at the 48.50s way up here. They were way out of the money, but I was able to sell those with some pretty good premium on, let's see, where's the 31st? Right in this wick here, right on the open midday range. Pretty easy to set a limit order and get that kind of premium. At the same time, on the same day, when price dipped down, I was able to sell those 42 strikes for a pretty penny as well. So the 42 strikes sit kind of in an area of liquidity down here at the base of the range currently that I wouldn't mind owning more. Even though my current cost basis on current position is in a little bit under the water at 45.06, I still have enough premium on that to not worry about that too much. My position cost basis since I started wheel trading TNA back in March of 2024 is all the way down at $19.92 per share. So I could care about being a little bit underwater with my current position. The goal here is to generate income over a long period of time. Sometimes you got to sweat a little bit. Sometimes you get a little nervous as price comes down through your current cost basis. If you're not into this for very long and you're not rolling these out and generating income, there will be times where your heart will pound and you'll see some serious unrealized losses in your account balance versus these types of positions. But you have to realize that you are focused on the long-term goal of income via options premium rather than share appreciation. Although you will be called away on occasion for your covered calls, that does happen. You gain the share appreciation from your cost basis, and the idea is to sell strikes that are above your cost basis anyway. So you win in that situation, and you get paid to wait to win. On the contrary, to acquire more position and if you are assigned on a cash secured put, add the cost basis of the shares acquired in that to your current position, divide by 2, and you have your average cost basis. And then the idea is if you end up taking possession of shares that are doubling your position size, if you can, if it's equitable, liquidate those shares for whatever you can get for them, hopefully on a price popping back up. And then you can take your share appreciation plus the premium earned on assignment and take that off of your current total cost basis. So there's a little math involved, a little journaling involved, but if you keep track of it, overall, you will eventually own something like this for free. And at one point, you might even own it for a negative cost basis. I have covered half a position size back in October before I acquired another short options position or sell to open puts. For a while there, I waited. Technicality is from March to October, I owned this equity for a negative cost basis of $1.36 per share. When I took another position, that offsets, so I have to add them together, divide by 2, and figure out where it met in the middle. At that point, my running total cost basis on acquisition of that position was $21.78, so I'm not doing too bad. Overall, I plan to own this twice for free eventually, and the idea is I can just continually generate income on this as time goes on. So current daily chart, I'm looking at kind of a potential risk for downside down here to even below $38. That can happen. The object is to not sweat too much. Currently, the liquidity zone I have mapped out on a 2-hour chart is right in play with the current daily 200 moving average. So I'm okay to be in a position there, and plus or minus a little bit isn't going to kill me. I can just acquire more cheaper and keep kicking that can down the road and generate income. So bit of risk involved in this, but if you are patient with time, you will eventually generate enough premium on it to own it for free and keep rolling. Overall, this has been a pretty well-performing ETF, even though it's triple leveraged against the Russell. It's got this really big capitalization zone here. Yes, that does broaden the range quite a bit. I have a long-term reversion target if things remain bullish here at about 63.40. That can happen. In the meantime, we've got this beautiful elongated rounding bottom with the uptrend happening now. So I'm pretty confident that this is going to continue to be a lucrative position to be in. This is what you look for. You look for something that's kind of bottomed, whatever it is, and you can do this with equities, you can do it with other ETFs, doesn't matter. When you find that the trend has been sideways and accumulating for quite a while and slowly developing into a slightly bullish trend, that's the ideal time to get involved with a wheel trade because you want to have a slightly bullish outlook on the equity overall over a long time. Look years down the road, not months. All right, so hopefully that helps you out there. I'll introduce you to another position that I am attempting to acquire recently here. Let me get this going really quick. Switch screens here. There we go. NVDX is a 2x long NVIDIA single ETF or single equity leveraged ETF. As you know, I'm pretty good friends with Matthew Tuttle there. He runs this particular exchange traded fund, and I found it to be, now that it's got nice liquidity in the options chain and weekly options, premium is outstanding on this one. Per dollar outlay on this thing, per side is upwards of 10%. So if, again, letting monthly expiration covered call and cash secured put at the same time out of the money, per outlay of each dollar, it's 10% on the puts, 10% on the calls, roughly. And if I was to just sell those to open and let them run to expire or assignment, they would each yield about that. So that's a potential natural yield, I like to call it, of about 20% a month. That's pretty insane. Like any other leveraged ETF, they tend to depreciate a little bit over time, less the operating fees of the ETF. But NVIDIA is one of those stocks you really want to own anyway. And if you can get 2x leverage on the equity, it makes it more of a day trading vehicle, sure, or a swing trading vehicle, yes. But if you're generating enough premium on it to own it for free, in a very short amount of time, what do you care if it depreciates? You're going to be constantly generating income on this thing. And if you're getting 20% back per dollar natural yield, yeah, it's a no-brainer. It's really worth the premium and really worth the risk, in my opinion. I don't think Nvidia is going to be bankrupt overnight anytime soon. Looking into the range, though, I sold some $10 strike cash secured puts recently, and actually I did it twice. It was so nice. No rhyme intended. Entered the first one. I sold to open on January 27th. Sold to open February 7th expiration, $10 cash secured puts at 90 cents. Closed them on the 29th, a couple days later. Bought to close those at 30 cents. That's a net of 60 cents per share off my cost basis without even taking a position. So it's an example of you can buy to close those options contracts if you feel that you're happy with the amount of premium you've captured. Also, at the time, I was pretty intent at seeing this give us a nice double bottom reversal, which it more or less did. We had it right down to the liquidity zone. So on the 31st, when I thought it was at support, and here it was, I sold those $10 strikes again, but I rolled them out to the February 14th expiration and received 90 cents credit for those as well. Currently, I can probably buy those to close at a nickel a piece and roll them out to the next expiration if I wanted to. I might even let those expire worthless and take a long position because I have a reversion target here at about $13.70. I may consider taking a long equity position and selling out of the money covered calls up in the $13.50 range to generate some extra income on this right away. Currently, I do not have a long equity position. I've just got the cash secured put rolling out. So I'll keep you posted on that one as time goes on, whether I decide to take a outright long position in the equity around here or if I'm going to wait for another pullback. Will remain to be seen. I'll see what the price action tells me to do. In the meantime, thanks again for watching, and I'll keep you posted week by week. So we'll see you every Friday. I'm going to try and get this out at 2 o'clock every Friday. We'll play it by ear, but I'm going to make this into a regular thing. Thanks again for joining. We'll see you next time.